Welcome to the Daily Block, the top events happening in the past day in crypto and why they matter. Strap in, this is 8 headline-sized swings that could either print green or wreck your weekend. First, Solana institutional wave. Forward Industries buys 6.82 DM Sol to 1.58 B, and Pantera confirms a 1.1 B Sol position. Forward Industries disclosed a monster purchase of roughly 6.82 million Sol at about $232 a pop as part of a $1.65 billion pipe led by Galaxy, Jump, and Multicoin. Separately, Pantera's founder publicly confirmed his funds hold a $1.1 billion single largest position in Sol. That's not retail FOMO. That's coordinated corporate treasuries parking eye-watering sums into the same token. Why it matters for traders. Big concentrated buys can suck up liquidity and trigger violent short squeezes and momentum runs in Sol and related alt pairs. Risk counterpoint. Heavy concentration means outsized downside if any of those players decide to rotate out. And buying at these prices leaves big drawdown risk if the market reprices Sol tech or macro exposure. Next up, XRP and Dogecoin spot ETFs moving this week. Rex Osprey, XRPR and DOGE via a 1940 Act route. Fund filings suggest a Rex Osprey spot XRP ETH, XRPR, and a Dogecoin product, Doge, are expected to start trading this week using a 940 Act structure, basically a regulatory fast lane that makes US access easier. For retail and institutions, this could be the first broadly available spot ETF ticket into these altcoins inside mainstream brokerages. Why it matters for traders. ETFs bring predictable, sticky flows and a huge new pool of capital that can light a fuse under XRP and Doge. Liquidity and volatility. Risk counterpoint. ETF launches can be front-loaded or disappoint on flows, and meme coins like Doge remain exquisitely sensitive to social media drama and celebrity tweets more than fundamentals. Moving on. BlockDAG pre-sale frenzy. 405M plus raised, hardware rollout, and jaw-dropping ROI claims. The BlockDAG story is running on full hype. More than $405 million allegedly raised, 26.2 billion tokens sold, nearly 20,000 miners shipped, and 3 million X1 app miners supposedly active. Promoters are dangling absurd ROI examples, the kind of percentages you only see in late-night infomercials and sketchy DMs. Why it matters for traders. Huge pre-sale raises plus real-world-looking hardware deliveries attract retail FOMO and whale flows that can produce violent pump-and-dump dynamics at listing. Risk counterpoint. Pre-sales have a long history of over-promise, under-deliver, and regulatory scrutiny. Listings can be illiquid or rug-prone, and headline ROI claims are often engineered marketing, not reality. Next, Ethereum ETFs and flows rebound, about $360 million inflows, and ETH steady above $4,300. US Ethereum ETFs recorded roughly $360 million of inflows, with BlackRock's ETHA apparently leading the charge with around $33 million, helping ETH hang above the 4.5K area. The ETF pipeline continues to act like a vacuum cleaner for institutional capital, and ETF-led narratives keep ETH flows steady. Why it matters for traders. ETF inflows are real liquidity drivers for ETH and tend to precede directional moves and rotation into large cap alts and L2 plays. Risk counterpoint. Flows can reverse if macro sentiment sours or if ETH inflows get priced in. ETH-driven moves aren't guaranteed to sustain without network or macro follow-through. Quick segue. Macro knocks the table. The Fed is widely expected to cut, and Tom Lee is calling a monster move. Markets are pricing about a 96% chance of a 25 basis point cut this week, and commentators like Tom Lee are publicly forecasting that easing could spark major BTC and ETH rallies over the next 1 to 3 months. A dovish Fed is textbook rocket fuel for risk assets, crypto included. Why it matters for traders. Macro catalysts like an imminent Fed cut can explode intraday volatility and create extended risk on momentum traders can surf. Risk counterpoint. The cut could already be priced in. The Fed's language may be less dovish than hoped, and market reactions can be counterintuitive if the Fed telegraphs a cautious outlook. Next up, Tether launches USAEI, a US-focused Genius-regulated stablecoin. Tether announced USAT, a US-targeted stablecoin built on its Hadron platform, issued via Anchorage Digital Bank, and with Cantor Fitzgerald as custodian, touting compliance under the so-called Genius Act framework. It's Tether trying to be the safe, regulated on-ramp for US trading flows, the kind of product many exchanges and institutions would love to use without sweating regulatory fallout. Why it matters for traders: a new US-compliant stablecoin from a major issuer could reshape which dollar-pegged tokens traders use for quick entries and exits, affecting spreads and funding across the board. Risk counterpoint: regulatory hurdles and slow adoption could limit its impact, and fragmentation across stablecoins may create confusing liquidity pockets rather than a clean winner. On to exchanges. BitGet anniversary plus UEX pivot and a huge BGB burn. 1.9B toasted. BitGet used its 7th anniversary to promote a pivot toward a so-called universal exchange UEX vision and publicized a reported $109 billion BGB burn, roughly 39% of supply. That kind of supply shock is the exact headline that stirs token speculators and squeeze hunters. Why it matters for traders: substantial burns materially change circulating supply and can trigger supply squeezes and repriced narratives for exchange tokens. Risk counterpoint: burns are sometimes accounting maneuvers, and markets can be fully forward-looking. So the rebrand and burn may already be priced in or fail to translate into user growth and real demand. And finally, PayPal adds one-time PayPal links and crypto P2P support for BTC Ethereum PUSD. PayPal launched single-use PayPal links for payments and rolled out peer-to-peer crypto transfers for Bitcoin, Ethereum, and PYUSD inside its 400+ million user base. That's mainstream Rails getting simpler, more social, and more usable. For everyday crypto flows, why it matters for traders: lower friction P2P Rails and merchant-friendly flows increase addressable retail liquidity that can push retail-driven volatility into BTC, ETH, and stablecoins. Risk counterpoint: product rollouts do not equal mass adoption overnight. KYC limits, transaction caps, and centralized controls could blunt the real capital inflows. That's the news that matters if you're day trading or living in subreddit muscle memory right now. Subscribe for daily shakes of market caffeine so your FOMO has a schedule. That's Today in Crypto, where the gains are imaginary and the pain is real.